Are tips and service charges subject to national insurance? In this video, we'll explain the UK NIC rules and what employers need to know.
Right, let's jump straight into it. If you're running a bustling independent cafe or maybe managing a multi-venue restaurant group here in the UK, how you handle the money left by your customers has, well, absolutely massive financial implications. Today, we're diving into the 2026/27 UK tax treatment of tips, service charges, and gratuities. This explainer has been put together drawing on the deep expertise of the tax professionals at Atlas Tax Advisors. They're an accounting firm dedicated to helping UK businesses master complex HMRC regulations. So if you're a UK restaurant owner or a hospitality manager handling staff tips, you are exactly who we need to be talking to today.
Let's start with a scenario that might hit a little close to home. Imagine it's the end of a packed Saturday night. You've collected hundreds of pounds in card tips, and wanting to be fair and transparent, you pool them all together and distribute them to your staff through your regular payroll. Seems like the completely right thing to do, doesn't it? But did you realize that simply running those pooled card tips through your standard payroll triggers a 15% employer national insurance contribution charge on amounts above the £5,000 secondary threshold? Yeah, that is a direct hit to your profit margins. And the crazy thing is, it's entirely avoidable if you understand the rules. A lot of people overlook this detail.
And really, that's exactly why the team at Atlas Tax Advisors have prepared this explainer. The regulatory landscape for the hospitality sector is shifting pretty dramatically right now. We're looking at a perfect storm of tightening employment laws and incredibly strict tax compliance rules for the 2026-27 tax year. ATA specializes in helping businesses like yours structure these tip distributions efficiently, making sure your staff get what they've actually earned while protecting your business from unnecessary tax burdens. To put this into perspective, let's look at a pretty shocking financial reality. Let's say your hospitality business pays out £120,000 in employer-distributed tips over the course of the year. Because you handle the distribution directly, you're looking at an extra employer NIC bill of around £17,250 on those tips alone. And remember, that is on top of the national insurance you already pay on their basic wages. A lot of taxpayers overlook this, assuming tips are just a pass-through cost. But in the eyes of HMRC, how you pass them through, that changes the whole shebang.
Okay, quick look at our roadmap for today. We'll cover the hidden cost of tips, understanding 3 different tax outcomes, mandatory versus discretionary charges, the trunk system solution, passing the independence test, and finally, the new 2026 tipping legislation.
So part 1, understanding 3 tax outcomes, because how tips are paid literally dictates the tax.
You see, the national insurance treatment of tips doesn't just depend on the simple fact that the money came from a customer. It depends entirely on how the tip is paid and who controls its distribution. Generally speaking, there are 3 paths a tip can take. First, you got cash tips left on the table and pocketed directly by the staff member. These carry absolutely no NICs for either you or the employee, though, of course, the employee does need to declare them for income tax. Second, employer-distributed tips, like those pooled card tips we talked about. These attract full Class 1 NICs. And third, tipping apps. Now, if the app pays the employee directly, it's treated like cash. But if the app routes the money through your business accounts first, boom, it falls right back into that employer-distributed category.
So, what exactly makes a tip employer-distributed? Well, this is a really critical HMRC test. If the money passes through your hands, your bank account, or your control in any meaningful way before reaching your staff, the NIC exemption just completely disappears. A super common mistake smaller independent restaurants make is treating card tips exactly like cash tips. They are absolutely not the same. The very moment that card tip hits your merchant terminal, it has officially entered your control.
Moving on to part 2, mandatory versus discretionary charges. This is a vital distinction. Let's talk about service charges. This is something many taxpayers first discover when reviewing their tax position. We really need to contrast these two side by side. A voluntary service charge is clearly presented to the customer as entirely optional. And because it's optional, it can potentially be distributed free of national insurance, provided you use the right system. However, a mandatory service charge is a completely different beast. If a customer has no obligation or choice but to pay it, HMRC treats it as contractually due earnings. Because of this, it is always subject to full PAYE and national insurance, regardless of how you distribute it. No exceptions.
Let's ground this in a practical scenario from our sources. Imagine a restaurant, let's call it La Brasserie up in Edinburgh. They add a 12.5% mandatory service charge to every single bill. Customers are told they absolutely must pay it. The result? Well, because the customer cannot refuse the charge, it forms part of the contractually due payment to the business. Therefore, it always attracts both PAYE and NICs, even if the owners try to pass it through an independent tipping pool. There is absolutely no escape from NI here. And, just to add another layer, mandatory charges are standard rated for VAT, whereas discretionary ones can actually fall outside the scope of VAT.
Part 3. The trunk system solution. Let's look at fair distribution and tax efficiency.
If you want to avoid that 15% employer NIC and the 8% employee NIC, you need what's called a trunk. What exactly is a trunk? Well, it's a special, formally recognized pay arrangement used specifically to distribute tips, gratuities, and voluntary service charges. And the person who runs it? They're called a trunk master. This must be an independent person who takes responsibility for sharing the tips among the employees. When you have a properly constituted trunk, the payments made through it are entirely exempt from Class 1 NICs for both you, the employer, and your hardworking staff.
But did you know? While a trunk beautifully wipes out that 15% employer and 8% employee national insurance burden, income tax doesn't just magically disappear. Nope. The trunk master actually takes on the personal responsibility of operating a completely separate PAYE scheme to deduct income tax before the tips are ever paid out. So it is a highly efficient system, but it definitely requires diligent payroll management.
Which brings us to part 4, passing the independence test. This has to be based on fact, not just a job title. HMRC is incredibly strict about who gets to be a trunk master. Passing their independence test is based on undeniable fact. To secure the tax exemption, 2 core conditions have to be met. Step 1, the trunk master must be allocating money that wasn't originally paid to the employer to keep. Step 2, and honestly this is the really crucial one, the employer must absolutely not determine the individual allocations, either directly or indirectly. Allocation means deciding exactly who receives what specific amount. If you, as the business owner or director, dictate the split, say you tell them, give 60% to front of house and 40% to the kitchen, you are influencing the outcome. And guess what? The exemption is instantly void.
Here is a professional tip for you. Navigating genuine independence is a bit like driving on a winding road with HMRC just waiting in the bushes with a speed camera. You have to stay strictly in your lane. Even informal, off-the-cuff suggestions from the owner about who worked hard and maybe deserves a bit more this week, that can collapse the NI exemption entirely. If HMRC investigates and finds the manager was actually deciding the allocation on a spreadsheet while the trunk master merely handed out the cash, they will apply full Class 1 NICs retrospectively. You must stay genuinely out of those allocation decisions.
Let's look ahead to Part 5, New Tipping Legislation Compliance, the 2026 Horizon.
So we have to bridge tax with employment law here, because while you must remain independent for tax purposes, you still bear the ultimate legal responsibility for ensuring tips are handled fairly. This timeline maps out the critical dates for any UK hospitality owner. First, the Employment Act 2023 came into force in October 2024. This made it completely unlawful to withhold any portion of tips. 100% must go to the staff who earned them. No admin deductions allowed. Next, as of April 2025, that reduced £5,000 secondary threshold for employer NICs took effect, meaning way more of your payroll now attracts that 15% charge, making a trunk more financially urgent than ever. And looking ahead to the horizon, 1 October 2026, that is when updates from the Employment Rights Act take effect, bringing in rigorous new duties for worker voice, mandatory consultation, and strict transparency regarding your tipping policies.
So, let's summarize the core takeaways of this explainer. 1. If you distribute tips directly through your payroll, you are paying a 15% employer NIC premium. 2. Mandatory service charges are contractually due earnings and always attract national insurance. 3. A genuinely independent trunk system removes the NIC burden for both you and your staff on voluntary tips. And 4. Those 1 October 2026 rules mean you urgently need transparent, written policies and active worker consultation moving forward. You have to monitor the trunk for fairness without actually directing its outcomes. It's a delicate but absolutely necessary balance.
If you are currently running card tips through your payroll, or, frankly, if you aren't absolutely certain your current trunk passes HMRC's independence test, now is the time to act. Please don't wait until you're hit with a retrospective tax bill. Contact Atlas Tax Advisors today. They can audit your tipping policy, help you set up a fully compliant trunk, and make sure you're fully prepared for those 2026 transparency regulations. Protecting your margins and your staff's hard-earned tips starts with proactive planning.
Finally, please note this brief disclaimer. This explainer provides general guidance only and doesn't constitute formal tax or legal advice. The rules surrounding Pay-A, national insurance, and employment law are highly complex and really depend on your specific circumstances. Always obtain professional, personalized advice from Atlas Tax Advisors before making any financial or structural decisions for your business. So, I'll leave you with this thought. Will your current tipping policy survive the scrutiny of the 2026 transparency laws, or are you already paying thousands in completely unnecessary taxes?